Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and as I like to remind you each and every week, I'm also the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks, and my company, Taylor Hard Money Advisors, is in partnership with Chen Lin, who publishes What is Chen Buying, What is Chen Selling. To sign up for either Chen's letter or my own, go to miningstocks.com, or you can call our office here in New York City during regular business hours at 718-457-1426, 718-457-1426. I want to thank each of you for listening to this show and making it one of the more popular shows on the Voice America Business Channel. Also would like to encourage you to send your questions, comments, criticisms, praises, what have you, along to questionsfortaylor@gmail.com. That's questions, the number 4Taylor@gmail.com. And I would like to invite you to follow me on Twitter at JTaylorMedia. Also, we do want to thank our sponsors for making this show economically viable. Our sponsors for today's show are Novo Resources and Dinocore Gold Mines and Cornerstone Capital. And we want to welcome a new sponsor today, Copperbank Resources Corp. And I might just add that we will be talking to the CEO of Novo Resources in just a few minutes from now. We do have an awful lot of ground to cover, so let's jump right into the show. I have named today's show, Are We Facing Another Global Financial Crisis? And I've given the title of this week's show based on a book written by Peter Wallison titled Hidden in Plain Sight. And Peter was a key player in the Reagan administration in helping to shape the deregulation of those years. Peter was general counsel to the Reagan Treasury Department, also White House counsel to the president. Mr. Wallison believes that increased regulation that has been set up since 2008-2009, contrary to the idea that has been sold to the public, it is not decreasing the chances of future events similar to 2008 and 2009, but actually increasing the probability of another catastrophe. So he'll be joining me in about a half an hour to talk about his thesis and his book, In Plain Sight, Hidden in Plain Sight. Then we're going to be talking after that, well, actually just in a couple of minutes now, as soon as, before we go to our first break, I'm really pleased to have Michael Oliver with me once again. He has some very interesting views on the markets, and I think you might find them somewhat contrary to the moves of today's markets. We're seeing a big jump higher in oil, a big jump higher in stocks. Well, we'll have to see what Michael has to say, but just in reading his prolific work, I would find it sort of surprising if he believes that we're on to the good times again. The party is just starting. But anyway, we'll hear what he has to say in just a second, a minute or two from now. And then after we come back from break, I'm going to be talking to Dr. Quinton Henning. He'll be with me to talk about what I think is the most exciting gold exploration development story in the world. And that is saying quite a lot because I have covered and followed a lot of these companies for many, many years. But it looks for the world to me as if Dr. Henning has found another geological environment that's similar, if not identical, to the Witwatersrand gold deposit of South Africa, from where nearly a third to a half of all the gold ever mined in the history of mankind has come from. And not only that, but interestingly enough, in the shorter term, because exploration usually takes a long time, in the shorter term, Novo Resources, his company, is in the process of moving its project in Northwest Australia toward a bankable feasibility study. So we'll be talking to Dr. Henning about that as soon as we come back from the break. Now, of course, the issues with gold mining and exploration takes a lot of time. If you don't have the patience to wait for Novo to find the next Witwatersrand, we have with us right now Michael Oliver, who has some things to tell us about the markets today and the things that are moving right now. So welcome, Michael. It's really good to have you with me again.
Good to be back, Jay.
Always good to talk to you. We're constantly hearing the mainstream press trying to convince us that the Keynesian economic theories are working, and it's just a matter of time before we achieve what Keynesians call escape velocity, meaning that the economy is back, it's healthy, it's growing, we can have tax revenues to cover the deficits, everything's going to be honky-dory. It sort of reminds me of the refrain that I heard my grandparents talk about in the 1930s. The refrain then was, prosperity is right around the corner. Now, the idea that the economy is improving doesn't seem quite right to me as I look at the data. from a fundamental point of view. But I'd like to get your picture of things, actually, Michael, from your technical viewpoint.
Well, I think the collapse in commodities that now everybody is aware of, actually most commodities crested in mid-2011 along with gold, which was in August, September of 2011. Oil and copper, however, were somewhat laggards, oil especially. Lumber might be thrown in that category too. But things like the grain market, sugar market, cocoa, gold, silver, they got really beat up. And they paid their dues. They collapsed big time. But this was over the last year or so. Now suddenly oil joins in and everybody's aware of it and they're all emotional and this is, et cetera, with all kinds of implications. And no doubt there are implications. I'm not going to posture as an economist, but you do not take a market like oil and nuke it off the page without there being some rationale for it, and it's not merely a supply issue. There's other weaknesses out there, and I think oil is just simply expressing that. So is the weakness in copper, and I think there's going to be vast weakness in lumber as well. Another market as well would be cattle, which is also a laggard commodity. But on the whole, I think the commodity collapse is substantially over on a price basis. Oil's probably, my suspicion is oil has not seen its low. That this is a flare of a rally in a vacuum situation. In other words, when you sell a market out, you basically run all the sellers out. They sell. If they're going to sell, they've already sold. And you have a phenomenon where when you get bids, it's thin air, and it goes up rapidly. At some point, the offers will come back in. My strong suspicion is that it will be probably in the mid-50s, and I suspect you're going to roll back over, and either slowly or rapidly, you'll retest that low. I don't think it's a big issue whether you take out that low or don't take it out. The main issue for the oil, the things that are vulnerable related to oil, is the time issue and the general price level. It's like a fuse burning. You want relief and you want it now. Well, This is not relief. This is a flare of a rally. It might be the beginning of a process over 6 months, 9 months of a basing process. But even if it is that, and I'm not sure of that even, there will be laboring at lower levels than this before that process is over. So I see no V-bottom possibility in oil where you merely simply go 50, 60, 70, et cetera. I don't see that as a technically viable possibility. Sometimes in some markets that is, but I do not see it in oil. So I'm of the opinion that, no, this oil is with us to stay in terms of time, several more quarters at least. Yes, true, you may be nearer the end of the decline in terms of the price level. I mean, you're not going to zero, but any instant glorious relief is you're throwing good money after bad to chase the oil rally.
Right. As you said last week, it's the rapidity with which this collapse has taken place that is really likely to cause trouble. I mean, if you had a year or so or 2 years to digest this, it would be one thing. But the rapidity of which this collapse has taken place is obviously, pulled the rug out from under a lot of companies, especially the highly indebted companies, the leveraged companies. But so do you think what we might be seeing here today is like a short covering rally or something like that?
I think it's a short covering rally, and it may be the beginning of a basing process, but the basing process will entail lower prices yet. So you might be near the upper end of the basing process, in fact.
Okay. Yeah, go ahead.
For oil. But don't let that. I think that cloud of quote deflation in the commodity sector tends to cloud certain other issues like gold, and I think it's greatly mistaken to mix gold into this. First off, gold paid its dues big time.
Yeah, a long time before oil did.
Yeah, a long time. It based for a year, due diligence basing all during 2014, half of 2013, plunged the lows, went to 1140, which was our predicted low, and said, no more selling down here, and it went up at over 1,300. Now we're laboring below that level. That's my next key level in gold, by the way, is to get clearly out above 1,300 on a weekly close. I did, in a recent report, plot an important relationship, I think, that is now shifted. And it changes day by day, but I plot it on a monthly and a weekly basis, and that is the spread relationship between gold and the S&P. So do you want to be long gold or long stocks? Well, for the last 3 years, it's better to be long stocks, not gold, obviously. But since 2000, if you bought gold, then it was at 19% of the price of the S&P. it went way up into the, I think, 70-80% of the price of the S&P, dropped down into the 55% area. So even the recent low in the gold spread versus the S&P was in the mid-50s on a percent basis versus the starting point at 19% in 2000. So despite the big drop in gold, gold still long-term has held its value. And in my assessment, that spread has now turned back up. I think it is now back in positive mode for gold after a 3.5-year decline. And going forward, it's better to own gold than the S&P.
So we want to see 1,300 taken out. That will convince you that we're
on a weekly close, preferably monthly. Get up above there. We traded above there 2 weeks ago briefly, but I want to put the elbow over the curbstone there and close well above 1,300 on a weekly close. It's not just a price issue at all. It's a lot of momentum factors involved there, and that's, as far as I'm concerned, that's my last bull hurdle. You cross that one.
And then I think, though, you did talk about 1,600 being the one after that.
1550 is my next target, but I actually see reason that if you get, there's basically a vacuum in gold right now between about the low 1300s and going up to 1550. In other words, we've labored layer after layer from 1140 to get up to here.
Yeah.
But I don't think that process will be that layered if you can get out above 1300. I think there could be a relative vacuum where you can quickly get up into the 15s. And I could even see, if you get there this year, even by mid-year, let's say, you could see 1,600. Let's get over the 1,300 first. But I think there could be a reverse oil situation there if gold does that.
Yeah, well, it's going to be fascinating to watch, and I look forward to talking to you about it some more. Certainly, so you see the equity markets weak here?
I think that equity markets are topping, period, exclamation point. Annual momentum says so. Most of my long-term momentum indicators resoundingly say, do not trust rallies. They are fitful. They're trying to fight that which they're probably not going to overcome. I would also circle the low we just made. It was just above 1980 the other day.
Yes.
I think that was an emotionally exhaustive level for the bulls who've been probed to the downside all during last month. They got down into the 1980s. We took out those lows with the stab the other day, and it didn't follow through. Therefore, they think, oh, the party's on again. Yep. I do not think the party's on. I think if you go back through that low, you'll have emotional capitulation.
Well, it's going to be fascinating to watch, and we're really looking forward to talking to you again, Michael. I hope you can join us again next week, perhaps for an update on these markets. You really provide very fascinating commentary, and I know in looking at your work that it's worth paying some attention to it. And I might just tell our listeners before we go to commercial break that they should go to Oliver MSA. That's Mary Sam Albert. That's olivermsa.com for more information on Michael's service and to sign up for his very excellent, prolific newsletter that comes out multiple times a week. Thank you very much, Michael, for being with us. I look forward to doing it again next week, hopefully.
Bye-bye.